Welcome back. I'm Michael Dresser. You're listening to Thought Beyond It and Provoking Talk on Dresser After Dark. Jeeva Ramaswamy with us is the managing partner of GJ Investments and its funds, an investment fund modeled after the original 1950s Buffett partnership. And since its inception in November, she's laughing at me, November 2008, GJ Investment Funds delivered compounded annual returns of more than 72% net to investors. And he's been favorably profiled in International Alternative Investment Review and Hedge Fund Exchange. And prior to GJ Investment Fund, he was the CEO for Miracle Software, Inc., an information technology and solutions company. He holds a bachelor's degree in electrical engineering. And I'm not even going to try to say the Institute of Technology. Jeeva, how do you say that? Coimbatore?
Coimbatore Institute of Technology.
Ah, great. Okay. All right. Hey, by the way, thank you so much for being here tonight.
Yeah, great to be with you, Michael.
Oh, thank you. Now, you wrote a book called Creating a Portfolio Like Warren Buffett, a high-return investment strategy. Jeeva, let me ask you this. Most people that we want to be able to invest, we want to have some kind of confidence, but most people don't get what they want out of it. You take a guy like Buffett, and for years and years and years, he's been there. He's hit it where most people haven't. What was it about Buffett that caught your attention that you wrote the book about and modeled what you do after?
I got interested in Buffett in early age, around like 20. I was looking at how to invest in a stock market. At the time, Buffett, very famous. Then I read about all his article, his annual report, the investments he was doing. So I was learning a lot of Warren Buffett investing principles. Then I started putting in a practice. So the main principle is you need to focus stock market investing as a business owner point of view instead of holding tradable securities. That's the main thing I learned from Buffett. Then I put it into practice. So I had very great success in my personal investing. Then I got a confidence. Then I started the fund. Then fund also, return also, it's very, very good last 3.5 years.
Now, by the way, what is it about the fund in and of itself that's consistent, that's constant? You know, we're living in a world now, even globally, not even just the United States. The economy, we're just not sure what it is, and nobody can really guarantee anything. Or is there any magic to the ability to invest where it's not going to fall apart? Because there's a lot of frightened people out there with money to invest, but they're afraid to let it go.
Yeah, what happens is investors behave differently, uniquely in the market. What happens is you have to invest when the world it's in a pessimistic condition. So when everybody is afraid, you have to be greedy. Then you have to be afraid when everyone is greed. So what happens is in 2008, financial crisis happened. Everybody was selling their securities, not even thinking about what is the company worth. So they are worried about all kind of news coming in media. They are afraid, they were selling. So think about those guys who sold their shares during the financial crisis. Now it's almost doubled. So what I did is I went and bought a lot of stocks in financial crisis that delivered me great return in 2009 and 10 and 11. For example, for one company, I bought it, my average price is around 45 cents. I sold it around $10. So I made more than 20 times of my money within a couple of years using this simple investing philosophy. So recent example, you can take it. Last year when the U.S. debt downgraded, people were selling left and right. Market went down 6-7%. I bought multiple stock on that day. Today it's almost doubled. So what investors have to do is when the market in most pessimistic condition, they have to buy the stocks they like.
Now, one of the things that I know that it's in the book, it's called the Stock Research Checklist. Very important to be able to be intentional about what you do and not just invest. You've got to have a handle on what it is that you're doing, and more importantly, why you're doing it. Now, the stock research checklist. What's that composed of?
A stock research checklist to gather information maximum from the company annual reports, from their earning release and everything. So this research checklist starts from do you understand the business? What kind of a business is this? Is this business have a moat? Do they have a sustainable competitive advantage? It starts from there, then it goes to earnings, their profit margins, the management characteristics, their inventory levels, their debt level, what kind of plan they have it for the future. So it goes one by one. So I put my 20 years of investing experience into this checklist. So when you go over one by one, you can say this item is pass, fail, and everything. End of the checklist, you can have a clear idea in and out about that company. Is this company is worthwhile to invest or not? So that is the checklist items. I put it into the book.
No, I see it right in front of me. If you really look at this, how comprehensive it is. Take a company. You look at their debt. You look at their equity, what it is that their net worth, the profit margin. Profit margin meaning, quote unquote, you sell an item for $100 and it's going to cost you $80 to get the item, so now you got a 10% profit margin. So if you really work your way through this, you truly know who you're putting your money with.
Yeah.
And the outcome. Okay, now management, very important. You can do all the research you want. You can apply all the principles, but if you don't manage what you do, you got a problem.
Yes.
Now, the investment management, how do you, in the book, in and of itself, some of the tips that we know that we're on the right road and doing the right thing?
Yeah, the one thing is you have to calculate the intrinsic value of the business, and also you need to buy when there is a discount to intrinsic value. What it means, say for example, you are calculating intrinsic value of the business is say $10. If the stock is trading at $11, you should not buy it. Even if it is trading at $10, you should not buy it because you need a margin of safety. So you have to buy maybe when the stock is trading around $7 or $5. So you have a 25 to 50% discount to the intrinsic value, so you have a margin of safety. So that is very important. The second thing is it's a portfolio.
Well, let me hold you up. It's very important so we make sure the audience gets this. You're talking, let's say, $10 a share, but you don't want to buy in at 10. You want to make sure when you buy, if it happens to go for 7, that gives you a safety net because the average value is $10, but if you're buying in for 7, that way it'll probably just end up increasing itself.
Yeah.
Okay,
yeah.
Good. All right, go ahead. No, go ahead.
Yeah. So another examples is portfolio management. Say, for example, if you pick the correct stock, you have to stick with that stock. So you have to think long term. Say, for example, take Apple. Everybody knows about Apple. Everybody using Apple phones. Lot of people are buying and selling Apple stock. Now, in last decade, if you put $10,000 in Apple stock in 2001 January, if you kept it for the whole 10 years, if you sold it on December 31st, 2010, you might have made 27 times of your initial investment. So you might have made around like 300,000 from 10,000 investment. So there are millions of users using iPhones everywhere. There are a lot of investors are in and out of the Apple stock in last 10 years. But if you had a long-term focus, you might have made a lot of money. So as an investor, if you are right about the particular stock, don't worry about you want to sell as soon as double, as soon as a triple. So as long as the company earnings is increasing in a decent rate, you have to stick with that company so you can make a lot of money. So if any investor made couple of investment like that, they can retire very rich. And also,
let me ask you this. I think it's an important question that, there's a tremendous amount of information in the book, but should a person go into the stock market by themselves, or do they need to come to a professional like you are? It's just like you wouldn't want to go to court without an attorney, and I don't necessarily know if anybody really should go into the stock market today without somebody, let's say like yourself, that has been there, has done that for 20 years, and they know exactly what to do, when, why, and how to do it. So the book is good, but would you recommend after the book, the next step would say come to somebody like yourself or come to you to complete this thing?
It depends upon different person's requirements. For example, as I run a hedge fund, it's allowed only high net worth individuals to invest in the fund. So that means the person should have a more than 1.5 million liquid net worth to invest in the fund. So those high net worth people can invest it in the fund, but if the guy is starting with 5,000, 10,000, instead of putting in mutual funds or something like that, they can try to learn investing in the stock market so they can get more return in the lives ahead. So, for example, I sincerely believe if the guy is starting very early, say around 20, if he's going to live for 70 years, so 50 years ahead of him, so if he can able to compound his money decent, just 10% annual return, he can able to make around 2.9 million before he retires. So it's a 10%, it's easy because, for example, if you take even Dow Industrial Average from 1950 to 2012, it's increased from 200 to 13,000. So it's increased around 65 times in that last 70 years. So if a guy is able to invest around 20, if he is able to compound money at 10%, he can retire very, very wealthy.
Okay, now, and it's compounding the money, let's say at 10%, but retirement, the value of a dollar today is starting to decrease because of all those variables that come into play globally or internationally. How do we make sure that when we set a retirement program up, that there'll be enough money to satisfy the consumer demands out there? Because we're talking about, if I just pick a number, if it costs $2,000 a month to live right now, that same $2,000 you could be getting from a retirement program might not be enough to satisfy what it's going to take to live. It could cost you $3,000 a month to live. So how do we make sure, based on inflation, we have enough at the end of the day so we can be comfortable and we can have a safe retirement?
Yeah, so in this environment, the equity, it's the best solution because dollar is going down all the time, inflation is going up. So you have to pick a stock where that company products can able to raise the price according to the inflation. Say, for example, take Coca-Cola. So they can able to raise the price even 1 or 2 cents when the inflation goes up, their earnings go up. So you have to look for companies where the company product can able to raise the prices according to the inflation. Even then, they don't lose the market share. So you have to look for companies like that. So then you can compound your money with higher return. So that way you can able to have enough money for retirement.
Okay, now let me ask you this, Jeeva. Is the book written in such a way that the average person can maneuver through and get everything that you want them to get out of it?
Yeah, that's when I was wants to write a book, 2 things were clear in my mind. The book should be written in a simple and easy to understand and easy to implement. The second thing is I put it in a step-by-step guide how to do investing. It starts from what is your mindset. You have to invest with a business owner point of view. Then where to search stock like Warren Buffett does. He just uses a value line to search for the stocks. Then the third important, already I explained, the checklist items. 61 research checklist items. You can get lot of information from the company. The other thing is how to calculate the intrinsic value, then buy discount to the company worth, then how do you manage your portfolio, then when to sell a stock. So I put each and every step-by-step investing guide into this book.
Okay, so you mentioned something which is very important, the when to sell, when to buy. So timing is also critical. And I would imagine that the stock market is like history. It's cyclical. It's going to rise, it's going to fall, it's going to rise, it's going to fall. And if you've been around the industry long enough, you can project about where it's going to go within a time certain. Are we talking about something like that, a way to learn that?
Yeah. How you learn that is when the market is, again, the same thing, how you value the company. If you understand the company very well, then you can able to buy at lower prices. When the market is keep on going up, don't be greedy and buy at inflated prices. So stick with company value, give enough discount, then buy it. So if the other guy is buying, stock is going up, that's not a good reason to buy a stock. So there should be a reason. If a company is worth $10, if it is around $7, buy it. If it is more than that, don't buy it. So that is the discipline every investor should have it. Then only they can able to make money on the stock market.
Now, by the way, we're starting to run out of town. Let me ask you this. Do you have a website we can find you at, buy the book, and get more information?
Yeah, they can buy it at Amazon.com, or they can go to gjfunds.com. There is a link, so they can click on it, then they can buy the book.
Wonderful. Okay, by the way, thank you so much for being with us. I've appreciated your time. And if they missed the website, if it won't buy too fast, we'll have it up on our website so people can find you.
Okay, thank you very much, Michael.
Oh, thank you. Take care. Good night.
Bye-bye.